Hey, Scott.
Good morning.
I've been doing my best to entertain people for the last 10 minutes.
Well, great, great. You know, I think it's useful to have a warm up on risk because you know, there's such a variety of opinions and ideas, and we're going to talk specifically about that today. Thank you very much for having me, and for those of you online, I hope you find this discussion a little bit more than just a straight presentation of information, but really an exchange of ideas. We want to leave a little time at the end for your comments and feedback and questions.
Yep, I've done a brief introduction and rambled on about what little I know about ESG. So I can hand straight over to you, Scott, to do an intro to yourself. And yeah.
Great, great. Very good to be. Sure, very good to be here, and I look forward to really, you know, a lot of times on these webinars, I see that the exchange of questions and comments is as valuable really as the information that's presented. I've been working in the field of project management and risk my entire career, and I see a really interesting confluence of this. Just to give you a little background, and I'll throw up the presentation here just so you can get a little bit. If you can allow me to share, Anastasis.
Yeah, I have done that, Scott. I'll just double check.
Okay, great. Okay, I've got disabled participant sharing. I signed on as a participant, so.
Okay, are you okay now?
Let me see. There we go. Yeah, let me share this. And let me get the full screen view here first. Again, welcome to the presentation. My name is Scott Randall, and just a little bit of background on me. I have worked in the engineering construction business most of my career, but also in the area of risks. And so kind of starting from this place of project risks, expanded out and worked in financial risk management in a trading and a marketing operation in the electric power business, and worked pretty extensively in market intelligence and strategy internationally. So the kind of the convergence of those three things. I've taught at the University of Houston and published a book on enterprise risk management. Really, risk management is my passion. And I often say in our project management courses, if there were no risk on projects, then we would not need a project manager. A project manager really is a risk manager. So the confluence of these two fields is really very interesting. The management of a project, the process of managing of a project, and the tools involved in managing a project are essential for controlling and mitigating the risks of a project. However, the field of risk management is much broader than that of project management, and there are some specific tools related to the management of not only risk, but also of uncertainty that we'll talk about today, and how it fits into the kind of the context of the energy industry as we see it. Again, I run a project management training company here in Houston, Texas, as well as a risk management consultancy. Let's just talk and clear the deck here in terms of what we mean by risk. Okay, and I know you've had that discussion. I guess I'd like to get some feedback from what people think about this definition of risk, because I've dealt with this and struggled with this whole risk idea for the last 20 years and found that there seems to be still even today, a lack of a common definition of risk. And it continues to surprise me that there's this lack of a common definition of risk, because it's been pretty well codified in ISO standards. ISO 31000, for example, is kind of the global risk standard. But risk is not a brand new field. Rather interestingly, I would say that really the most fundamental shift in the standardization of risk came out of Australia with the Australia-New Zealand standard, 4380, I believe it was. That really put together not only the fact that we've got a risk, but we've got a series of tools and a process within which risk can be managed. But getting back to the definition, you know, there are a lot of definitions, but some people say, well, it's uncertainty that matters. I don't really care for that definition. Some people equate hazards and risks in the same breath, and we'll see. I guess I can talk a little bit about the differences, but specifically, a hazard is just something with the potential for creating a negative consequence. It doesn't necessarily have a likelihood attached to it. And it's actually something that you ought to embrace in your operations, as strange as that may sound. A hazard is something that's a normal part of doing business. You get rid of all the hazards in your business, you'll probably not have a viable business to conduct. So risk and hazard are not the same. Risk, really, I would say the most fundamental thing about risk is that it really needs to have some measure of likelihood and some measure of impact. And now you notice that I didn't say consequence there, and that's key because the definition of risk today includes not only the upside or the downside, but the upside of an event as it occurs. And that's really, it's interesting, just as a side note, some of the trends in ESG I see that, and ESG risk in particular, that people are talking about are starting to muddle the definition of risk. So from a risk purist standpoint, I think we need to be very careful, because once we start muddling this definition, then we start to kind of dilute the ways that we can manage risk. And we dilute the tools that we can apply to particular risk issues. So just getting that off the table, I'd like to establish that for our purposes, we're really talking about a function of likelihood and impact. And I say a function because it's not really the product thereof, but it really is the combination of likelihood and risk in a non-mathematical way. And why I say that is that you can have something that's extremely low likelihood and extremely high impact, and that could be considered something other than a medium risk. If you just take the product, perhaps, of those two, you would come up with something in the middle. When in fact, something like, for example, a well control event, many would consider that a low likelihood, very high impact kind of an event. And yet many operators, particularly, again, this is a little bit old news, but many operators in the post-Macondo environment would consider that a high risk. And they factor that into their risk analysis, in spite of the fact that literally the multiplication of the likelihood and the impact would maybe lead you to think that it was a medium level risk. And again, that varies across different operators. So again, I'd like to focus on the fact that it's not simply the product of likelihood and impact, but that likelihood and impact are probably the most fundamental and core elements of what makes a risk, what defines something as a risk. Let's just talk a little bit about global events here and give a little background to why we're even dealing with this. It's interesting because I would say up to the pandemic, up to the war, we were seeing kind of this constant drumbeat of a growing loud cry toward the focus on something other than what I would call optimizing shareholder value. And we saw, I would call this a seminal event, and that is the Exxon board kind of acceptance of this lone wolf, seemingly lone wolf investment fund called Engine Number One. The forced acceptance of Engine Number One as part of the ExxonMobil board in June of last year. I would call that a kind of a seminal event. What it really means is that it's not just lip service that has to be paid now to some of these activists that are promoting the environmental, social, and governance agenda. And in fact, what we look at is that there are some people behind this that are quite powerful. Surprisingly, three particular individuals that not many people talk about, but there was a recent economist article about them, are Mark Carney, who was the former Bank of England chief, Larry Fink, who is in charge of BlackRock, the world's largest investment fund, and Jamie Dimon, who's J.P. Morgan Chase's chief executive officer. They've all kind of teamed up and said, we are going to promote this ESG agenda globally in financial markets. That's created quite a backlash now, particularly from the right, who's looking at this as woke capitalism. So we've got some pushback. We've got some very solid, very, very powerful backers for this ESG momentum that's growing. And then we've got some other trends. I mean, obviously, the kind of overarching trend in the energy industry right now is a geopolitical trend, dealing with the real shift and the shortage of hydrocarbons in the world, and the shift of natural gas shipments to Europe from the United States and from the Middle East. So we're seeing a real overarching global issue that is kind of pushing back against this ESG movement. I would say putting it on hold to a certain extent. I mean, the announcement by the European Commission just a week and a half ago, calling natural gas and nuclear energy green sources of energy, it was really a kind of a shock to the entire what we would call ESG movement. So it's not very clear what's happening here in ESG. Whereas I would say prior to the pandemic, prior to February 24th, it was more clear that there was definitely an ESG movement underway, almost this train that was unstoppable, that was going down the tracks. So the picture is a bit more complicated now, and then we feather in this this uncertainty about the global economy and possible recession. Certainly, we're looking at recession in the United States, and as I understand in Europe, they are as well. We've been a little bit more, I would say, proactive with respect to our central bank, the Federal Reserve, raising interest rates immediately. But I think that we're going to definitely see an impact on ESG trends and ESG activities as a result of this growing uncertainty and growing, I would say, real fear of a recession. That's going to mitigate some ESG kind of activities. So again, all of these things are to say we're not only talking here about risk, we're really talking about uncertainty as well. So we're seeing these two issues, and what's the difference between risk and uncertainty? Well, risk is really, again, going back to our definition, it's where we have a likelihood and an impact, whereas uncertainty is generally understood to where we don't have a discrete likelihood attached to it. We can't say 50% likely that there will be a global nuclear war. Although people would love to attach some likelihoods to this possibility of a global war on a nuclear, using nuclear weapons, I think it's foolish to look at World War III, for example, on a nuclear basis as a risk event. It really needs to be considered an uncertainty, something with an impact that can be visualized, but there's no way to attack it with a likelihood. So we really don't, we have to use different tools. We can't use the same tool like a risk register, for example, to really deal with global nuclear war, because that key element of assigning a likelihood cannot be just assigned to that. You might put it in your risk register as an uncertainty, maybe on a different sheet, but to deal with it in the same way that you would deal with a process safety risk, for example, that you would have a fair amount of historical data and real quantitative historical data, I think is misleading. So it's important to talk about the difference between risk and uncertainty and recognize that you need to have a process and you need to have tools, and there are different tools for each one of those, for risk and uncertainty. Again, this little spectrum diagram comes out of my book, deals with the level of information that you have all the way up to control, which no one can really claim to have control over things. But the better the information that you have, the higher up the spectrum you can kind of move. Let's talk about some global, I guess some global background prior to the pandemic, prior to the war, that really started this train down the track, I would say. It's not that nobody ever talked about sustainability in the past. I'm sure we can all remember the days of triple bottom line and corporate social responsibility, those buzzwords, those terms, and even those trends that many operators put in place with specific measures and reporting. But really, it wasn't until, I would say, these financial concerns got into the picture that we began to get some traction on these international initiatives that were initially kicked off by the United Nations. United Nations Strategic Sustainable Development Goals are things that are often used as kind of the starting place for ESG initiatives. The IPCC, Intergovernmental Panel on Climate Change, established kind of a set of targets, specifically and most notoriously, the 1.5 degrees centigrade kind of target has been bandied about, and then there's a fair amount of scientific research, published papers behind that look at our progress. And then more recently, what they call the Task Force on Climate-Related Financial Disclosures. That's a really serious type of a sub-organization that came out of these UN-sponsored initiatives that we really need to keep track of, because they are now beginning to get down into the nuts and bolts of how we deal with environmental, social, and governance requirements. And it's important to talk about requirements because everyone is really focused today on meeting those requirements. Again, keeping in mind that we've got these overarching global and geopolitical issues that are somewhat mitigating that. But where do those requirements come from on a very specific basis? And we see a few areas. We've got some standards bodies emerging, right? The Accounting for Sustainable Future Sustainability Accounting Standards Board that was formed as a subset of a larger organization. It's the SASB was really something that came out of the whole movement after Sarbanes-Oxley in the United States, after the I would call the merging of different standards bodies like the American Accounting Standards Board and the British Accounting Standards Board just about 6 years ago. We're seeing this coalescing of international standards. We're also seeing consultants coming out of the woodwork, certainly that will certify to those standards, right? And that will even make up their own criteria or their own protocols for inspecting and validating and certifying to those standards. And some operators are beginning to get a fair amount of traction around being certified to the standards. Project Canary is one of the more prominent in the oil and gas industry now that's beginning to certify companies to ESG standards. And what's interesting is that I think there's a whole lot of interest in environmental standards, particularly climate change standards. But the whole field of social and governance standards is not as well developed. In other words, even if we look at these emerging standards bodies, their focus seems to be very, very heavily on climate-related environmental concerns. And it's a little bit weak still on the social and governance. Some of these certification consultants have tried to fill that gap. One of them is Equity Origin that I've worked with a little bit, and they've put together a pretty nice, robust, what I would call checklist or protocol for not only environmental compliance, I guess, with ESG, climate change in particular issues, but also with social and governance. They've got some very nice material there. The question is, you can set a target. You can become certified. You can comply with these standards that are being created now and that are certainly not established yet. But what investors and other stakeholders are really looking for is assurance. And you can't get assurance simply by being certified. Assurance is a snapshot, or a certification is a snapshot at one point in time, according to some other body, that you comply with a certain checklist of issues. But it doesn't really give any forward-looking assurance. And that's where I think the whole field of ESG is going now, is providing that assurance around, are you actually going to be able to meet those targets? And what proof, what can you show me that convinces me that you can, in fact, meet those targets? And that's where the whole field of risk is coming in. And that's where this whole ESG movement is going toward, is providing that assurance, not just providing a check the box, and in the worst case, a greenwashing kind of an approach to ESG, but really providing some feeling that, hey, they've got a process in place, they've got tools that they're using on a regular basis, they're monitoring what's happening so that when conditions change, they can still meet their target, they still have some assurance on meeting these promises that were put out in their financial statements, for example, relative to publicly traded companies. So again, it's important to focus on the fact that when we talk about risk, we talk about likelihood and impact. even within many different financial agencies, we find a problem with risk and the definition of risk. If you look at the U.S. Securities Exchange Commission documents that are required by many publicly traded companies in the United States, the 10Ks or 10Qs, 10Qs quarterly financial statements, 10Ks annual financial statements. You see they have a section in there that deals with management disclosure and analysis, and they talk about risk in there, and often we see just a grab bag of things that aren't risks at all. Their hopes, their fears, their uncertainties, some of them are risks. But even within the financial industry, we see a mixing of these terms. And within ESG, I see a very troubling trend, and that is the mixing of the term risk and opportunity. In other words, as if the two were two distinct things, as if risk was negative all the time, and opportunity is something else. And in fact, what we ought to look at is risk is threats and opportunities, both the downside and the upside of an uncertain event on your operations. So I see this kind of troubling trend within ESG circles to kind of muddle the waters with respect to the definitions of risk by talking about risk and opportunity. And it's kind of being codified in the TCFD, the Task Force for Climate Disclosure documents talk about assessing risk and opportunity. I see that as a bit problematic today, because it tells me that they don't have a really solid grasp of risk management as a risk management definitions and risk management practice. Again, an opportunity for us, I'm taking it out, to really look at how is it that we can apply risk management tools and techniques to this emerging field of environment, social, and governance issues to be able to provide that assurance. We have to have a process, as I mentioned. I mean, we could look at, kind of different tools. If we were to look at a specific prospect, say you were to look at some shale developments in the western part of the United States, and I've looked at this right now. We just had a leasing round of onshore shale developments a week and a half ago, where this ESG issue was very, very important in the assessment of the bids that came into our Department of Interior's bidding round. If we were to look at that, we would say, okay, we can comply with all of the requirements, but how are we going to give the regulator some assurance that we actually can deliver on those targets? And for that, we should apply our standard risk tools. Many of us are very familiar with risk register, risk matrix, going through, and even bow tie diagrams are useful in understanding cause and effect, and being able to illustrate a kind of a barrier-based approach. By being able to embed this in your lease documents, for example, this process that you might have and these tools that you might use, even though they're well-known tools, the fact that you're explicitly talking about using these to provide assurance gives assurance, okay? The fact that you can talk about the process, you can talk about the tools that you're going to use, gives the stakeholders assurance that you will be able to meet the targets. And that's really important because we're seeing a massive shift from optimizing shareholder value to optimizing stakeholder value. And you say to yourself, how can we optimize stakeholder value when we've got 500 stakeholders? Well, what people are not talking about and kind of avoiding is the whole issue of prioritization of stakeholders. Quite frankly, some people don't matter. From a company standpoint, it's important to recognize that the squeakiest wheel doesn't always deserve the grease. It all depends on how powerful those stakeholders are and how they could impact your own objectives as a company. So this stakeholder prioritization is key to being able to move forward in dealing with these ESG issues. And standard stakeholder management tools are going to become more and more important now in the ESG space. Things like putting together a stakeholder register, stakeholder matrix, a stakeholder communication plan. Being able to really specifically have a process for stakeholder management is one of the core aspects of being able to deal with ESG issues and providing that assurance. A key, we've seen some real interesting events recently that that show how even established companies can get this wrong. The recent Disney activities in Florida prior to the establishment of certain legislation dealing with school curricula in Florida and gender issues. About 2 months ago, 3 months ago, Disney, quite frankly, got it wrong. They didn't focus very well on who the powerful stakeholders were and adapt their message and adapt their approach to dealing with those powerful stakeholders. And in fact, they suffered quite a public relations hit as a result. If they had focused a little bit more on stakeholder analysis, and you would think that they would have this kind of down pat by now, but even pipeline companies are getting tripped up with this now and have been on really ignoring some powerful stakeholders and focusing on some that may not be as important. I would again just say that a robust stakeholder identification, assessment, and planning process is going to be critical moving forward. That's all part of risk management. Another trend in ESG that's important is looking at what we want to call scopes. There's scope 1, scope 2, and scope 3. And what do we mean by that? Well, if we look at the drilling contractor's value chain, for example, scope 1 is what they do. Okay, this is their business. This is kind of the life cycle of a drilling contractor's business. But if we were to look at scope 1, 2, and 3, and here I've got an example of Oxy's, the operator Oxy, out of their annual report, they very clearly talk about not only scope 1, which is their activities that they do, but also their suppliers, scope 2, electric power being a supplier, and scope 3. In other words, what we're seeing is a requirement for you to look beyond your own business and look upstream toward your supply chain and downstream toward the off-takers of your product at the environmental, social, and governance issues related to what happens to your product after it leaves your plant and how is it that the raw materials come into your facility. That's what we're starting to see. And so again, it kind of tees up, how do we deal with scope 1, 2, and 3? I mean, how do I get our arms around that? And one of the key issues is we need to go back to a process for value chain mapping and looking at what do we do as a business, each one of these activities. If we were to look at scope 1 for a drilling contractor, we would see that, site preparation has a number of different activities and tasks. Casing and cementing has another series of activities and tasks. We would value chain that scope 1 out, just kind of like I've done diagrammatically, but then drill down into, pardon the pun, into the specific activities and say, who is it that supplies product to this activity, and what happens after we complete this activity, to be able to capture not only scope 1, but scope 2 and scope 3 impacts on ESG. that's one of the key things, is this value chain mapping. In addition to stakeholder identification and assessment, that I don't think that people are yet really conversant with in this field of ESG compliance and management. Another coming trend I see is toward stress testing and scenario analysis. Now, in the TCFD document, it talks about certain stress tests, and it talks about certain scenarios that you need to put together to consider. What I see is a trend toward more customized, requiring more customized scenarios from operators on what can happen, as opposed to picking these off-the-shelf scenarios from the TCFD documents. So the ability to be able to do scenario analysis is a core coming capability that companies are going to need to have, in addition to stakeholder analysis, in addition to being able to value chain their process. This scenario analysis is a core key, or a key risk management activity and competence that operators are going to need to have. In addition to, of course, being able to put together a risk register, risk matrix, all the standard risk management tools, this scenario analysis is something that's going to become more and more important. And finally, more quantitative work. Right now, we're looking at a very qualitative type of reporting of ESG. I fully expect that people want to see numbers. And not only do they want to see numbers, they want to see stochastic measures. They want to see probabilistic modeling behind your ESG risks. So I would expect that Monte Carlo analysis and probabilistic modeling is going to become more and more important over the next 3 to 5 years in the management of ESG risks. So I'll just leave it there. That's really what I have today. We've talked about, just to sum up a little bit, we've talked about macro trends. We've talked about the standard setting bodies that are setting up these standards, and certification private parties that are putting together ways that you can certify to those standards. And we've talked about the changing nature of stakeholders and the requirement of stakeholder optimization, and said, in this kind of very post-pandemic, hopefully post-pandemic, okay, but maybe very turbulent geopolitical and macro environmental turbulent environment now, we really need to focus on risk management now, and really need to look at value chain mapping, more in-depth stakeholder analysis, identification and assessment, the application of standard risk tools, and moving more toward quantitative measures and scenario analysis. So if I were to coach anyone on how to set the groundwork for the future of ESG risk over the next 5 years, I would say those specific areas are what we ought to really become very capable and competent in executing on, to be able to give assurance not only to the regulator for compliance reasons, but to the myriad of very powerful stakeholders who are now influencing the the boards really, and the direction of many corporate entities today. So with that, I'll open it up for questions. Do we have any? I see we've got a number of things in the chat.
There are a couple of questions, Scott. I'll just,
yeah.
I've got a couple here already.
Okay.
The first one was from Arun Dev. How should we deal with hazard and HAZOP which are potential sources for generating risk. And risk also starts with its identification, like we identify hazards. That's literally what's there.
Yeah. I mean, I think dealing with one of the things that's very powerful about process safety is a codification of tools. And HAZOPs, HAZIDs provide almost the toolbox, the conceptual toolbox, but actually the practical toolbox for being able to go through a process of identifying these ESG risks. It's not the same risk that you're identifying, obviously, but it's the same tool and technique and thinking that you're using. I mean, a risk manager has a tremendous ability beyond an accountant, for example, and I'm not picking on accountants, but to think in terms that are other than deterministic. They have an ability to be able, because they practice with HAZOPs and thinking about what could happen, have an ability to think in terms of scenarios. So again, your ability to do hazards and HAZOPs will really suit you quite well in this new ESG environment, beyond environmental, beyond safety, but into social and governance issues as well. Another question.
The other question, or the next question, is identifying risk. And elaborating on that is manually identified and quantified. What is the right and perfect method? Now, I don't know if there's a right and perfect method, but maybe you have one.
Well, I don't know what's right and perfect, but I do know that no matter what you do, you really need to start with what, and there's a book called The Art of, pardon me, The Art of the Long View, written by Peter Schwartz, an old book. But one of the key things that I'll never forget from that particular book, and it's on scenarios, it's on global future scenarios, is he says that you need to start with a suspension of disbelief. In other words, you need to say, I'm not going to say this cannot happen. I'm not going to think this cannot happen. I need to open up my mind and say, how can I make sure that I suspend disbelief during this process? And in order to do that, you need to have some brainstorming. You can't just go into this deterministically. So a key capability of risk identification has to be brainstorming, has to be open, facilitated discussions of what could happen to begin with. Another key aspect, I think, of identification is to have some kind of a framework and to weigh some kind of a document that you capture these things. Because it's one thing to talk. It's another to actually put them down in some structured way. And a third thing is to, and this is kind of tactical, but this comes out of hazards and HAZOPs, is to not just rely on a facilitator, but have a facilitator and a scribe in the room so that the facilitator can focus on having an effective brainstorming and not be distracted by having to scribe or type in the information into the register. So I would say those are kind of three good practices in risk identification.
Yeah. That's a good point on having a scribe and letting the facilitator focus on what he's doing. Next question is an interesting one, and it's failed projects and projects that have met catastrophic ends. How did they miss the risk management? Yes, in some cases, they probably didn't do it.
Well, in some cases, they didn't do it, but it's hard to imagine that they didn't do any in this day and age, particularly when we're talking on a massive scale. If we talk about the Berlin airport, for example, you know, that's a massive project failure, right? If we, I mean, Anastasis, you can talk a little bit more about Chevron in Australia. I mean, that is a massive project failure, okay? That's no unmitigated failure in risk management of LNG facilities, offshore Chevron, Australia. And I've talked to Chevron quite a bit about that, and case studies have been done on that massive project failure. And I would say that there's not one key issue. What it is a lack of being able to, I would say, follow and allowing events to get out of control of your process. In other words, if we look at the Macondo disaster, it's not exactly a project, but if we look at that, I see that one of the key issues there is that they did a risk analysis and then put it on the shelf, and didn't make it actually living and breathing. Another key element of the Macondo disaster is what I would call a lack of a RACI chart. Okay, at a certain point, they had a kick, and it took them 42 minutes to recognize that they had a kick. And by that time, the bubble had already come all the way up the riser, and it was way too late. And the problem was that they didn't have someone assigned to monitor the draining of that mud pit into the offshore vessel. Normally on a rig, you've got a mud pit, and you've got someone on the drill floor that's responsible for looking at the level of the mud. And if you see a rise in the level while you're circulating out, then you know that you probably have got a kick. And that was something nobody was assigned to actually look at the volume of mud and the acceleration of the flow of mud into the offshore vessel to recognize before 42 minutes that a kick had occurred. So I would say that the application of a RACI chart, knowing who is responsible when for specific things at different times, which could be considered a risk management tool, but is often associated with quality management or project management. But who does what when is critical, and that's one of the things that I see with the Macondo disaster. The Berlin airport, I think it's just too big. I mean, it's like the big dig in Boston many years ago, which was a major tunneling project that's a colossal failure, in risk management. I would say that the way the United States handled the pandemic was probably the most colossal risk management failure in our country's history. And you look at how this occurred, and I think you see that events get out of control relative to the process. People throw out the process and stop really applying these tools.
Yeah, I think in my experience, we've had a similar situation where, or not a similar situation, but a situation where politics within a company or within governments overrides technical and expert advice. Because somebody wants a project to happen, it just happens. Irrespective of whether it's right or not, or technically feasible.
Yeah. If we look at the Challenger disaster, for example, and the failure of the O-rings, we see that there was such a tremendous pressure on Morton Thiokol to release the go-ahead on the launch of that Challenger rocket, that it almost overwhelmed the technical advice. And in fact, the technical presentation was colored in such a way as to almost favor a go decision in the Challenger launch. Yeah.
The final question we've got here, I don't know if any more questions will be coming through. Hopefully, we've got a little bit more time if you want to send some through. Can you briefly summarize the difference between ESG assurance and compliance, ESG compliance?
Yeah. Compliance means that you're meeting the standard. The problem is that the standards are changing, one. Secondly, the standards are more what I would call prescriptive standards. And we've got, those of you who have been in process safety for a while know that there are kind of two regimes in the world in process safety, right? There's the kind of prescriptive approach that the United States uses, for example, in our regulatory bodies, where we've got a series of checklists. It's kind of like kind of like the difference between Napoleonic law and common law, in that you've got, you know, if you look at Napoleonic law, you've got all these codes that if you just check the box on these things, then you're fine. You know, whereas with common law, you've got a precedence system that looks at more what's the intent and how is it that it's changing over time, and how do we adapt our interpretation of that standard over time. It's more like the safety case regime that we see, where you have to kind of prove and provide some assurance to the regulator that you're actually going to run a safe operation, as opposed to a compliance approach would be, okay, here are the rules, here's the checklist, comply with the checklist and you're fine. What that doesn't recognize is what happened in Colorado about 4 weeks ago, where the regulator had approved a drilling plan 3 years ago for a series of operators, and they'd already started drilling in Colorado. And all of a sudden, an environmental group came up and challenged the regulator's assessment of the drilling permit in court, and were able to stop the drilling plan from going forward. You know, here this poor operator thought they'd had all of the blocks checked by getting a drilling permit from the regulator. We're good to go, only to be routed by these ESG activists through the court system. So you almost have to think ahead of the actual compliance itself and begin to think what could happen and how could this get tripped up. Again, a real focus on scenario approach and thinking rather than deterministically. You need to think more what could happen.
That's it on the questions that have come through in the chat.
Great. I hope this has been thought-provoking for people. Again, risk is a terribly exciting field, and I think that it's really exciting to be at this point in the evolution of environmental and social governance trends, and be at the forefront of these trends with the application of risk management. I would encourage you all to get your risk management toolbox out and sharpen those tools.
Okay, great. Thanks, Scott. As mentioned earlier, okay, just somebody coming through saying it has been really thought-provoking. As mentioned before, you know, if you're interested in consultancy or workshops or more further training, just to get in touch, and we can arrange that through Scott, whether it be for ESG, project management, or other technical topics in oil and gas upstream, or project management, which I just mentioned. Yeah, just get in touch. Thanks again, Scott.
You're welcome. It's been my pleasure.
Checking if there are any more questions, but no. Just thanks for the lovely talk. And we'll send an email out as soon as we put the video for this webinar up on YouTube as well.
Excellent.
Okay. All right.
Okay.
All right. Thanks, Scott.
Okay. Have a good day.
All right. Cheers.
Bye.